Hello and welcome. Today we're jumping into a topic that, let's be honest, can feel pretty overwhelming: Indian health insurance. We're going to be using a really straightforward guide from Dr. Sujindris SG to cut through all the noise so you can feel a lot more confident about the choices you make.
You know the feeling, right? You decide to look for a health insurance policy and suddenly you're drowning in hundreds of different products, confusing terms, and fine print. It is an absolute maze, and it's so easy to feel completely lost.
But here is the good news. It's not as complicated as it looks. All of those hundreds of products, they can all be boiled down to just 3 fundamental paths. Seriously, just 3. Once you get these, you'll basically have a map to navigate the entire landscape. So let's find your way. So what are these 3 basic paths? Well, every single health insurance product you'll ever come across is built on one of these core ideas. Let's break them down. First up, we've got the one you've probably heard of the most: the indemnity cover. The easiest way to think about this one is as the bill payer. It's pretty simple. If you're hospitalized, this policy pays you back for the actual itemized expenses. You know, the room, the doctor's fees, the medicines, all the way up to your policy limit.
Let's look at a quick example from our source material to make this crystal clear. So Raghu's hospital bill came to 1.25 lakhs. His policy had a limit, or a sum insured, of 1 lakh. So what happened? The insurance company paid out its full 1 lakh, and Raghu had to cover the last 25,000 out of his own pocket. It's a direct payment for costs, but it stops at that limit.
Okay, the second path is something called a fixed benefit cover. You can just think of this as hospital cash. Now, this is totally different from the first one. It doesn't look at your hospital bill at all. Instead, it pays you a fixed, pre-decided amount of money for every single day you're stuck in the hospital. It's really designed to help with those extra expenses, like travel or lost income, not the medical treatment itself. And our third path is the critical illness cover, or as we're calling it, the recovery fund. This one has a very specific and very important job. If you get diagnosed with a major illness from a list in the policy, we're talking things like cancer, a stroke, or a major heart attack. It pays you a large, one-time lump sum of cash. That money is for you to use however you see fit, to help manage your life and finances while you recover.
So those are the 3 main building blocks. Now that we've got the basic types down, let's talk about how you can actually structure a policy to fit you and your family.
You really have 2 main choices here. An individual policy is just what it sounds like. Each person in the family gets their own separate sum insured, their own private pot of money. A family floater, on the other hand, creates one big, shared pool of money for the whole family. Any family member who needs it can dip into that single, larger amount. This is why it's a super popular and often cheaper choice for younger families. This is the question that probably worries people the most. What on earth happens in a worst-case scenario? You know, a really serious medical issue where a single hospital stay creates a bill that's way, way bigger than your basic insurance coverage. Well, there's an answer for that. It's called a top-up cover. Just think of it as your ultimate safety net. It's a totally separate policy, and it has only one job. It wakes up and starts paying after your main health insurance policy has been completely used up. Here's exactly how it works. Let's say your main policy covers you for 3 lakhs, but you get hit with a single hospital bill for 5 lakhs. Your base policy does its job and pays out the full 3 lakhs. Then your top-up policy kicks in to cover that extra 2 lakhs. It's a really smart and usually affordable way to protect yourself from those catastrophic medical bills.
Now, beyond these core options, the market has all sorts of specialized plans. We're not going to do a deep dive here, but it's really good to know that these exist for specific situations.
For example, you've got senior citizen policies, which are designed specifically for people over 60. A lot of us have group health cover through our employer. Then there's personal accident cover, which helps if you're disabled because of an accident, and of course, overseas travel insurance for when you're out of the country. There's pretty much a product for every need.
All right, for our final section, let's decode some of that infamous fine print. This is so important because knowing these key terms is what empowers you to actually understand what you're signing.
Okay, let's start with 2 terms that people mix up all the time: copayment and deductible. A copayment means you agree to pay a fixed percentage of every bill, maybe 10%. A deductible, on the other hand, is a fixed rupee amount that you have to pay out of your own pocket first before the insurance company pays a single rupee. So one is a percentage, the other is a fixed amount. It's a really critical difference.
Next up, the big one:
Pre-existing disease. The legal definition is pretty specific. It's any condition where you showed signs, got a diagnosis, or received treatment within the 48 months, that's 4 years, before you bought your policy. Insurers do have to cover these, but usually only after you've waited for a specific period.
And that leads us perfectly to waiting periods. When you buy a new policy, you can't just claim for anything right away. There's usually a 30-day initial waiting period for any illness, though accidents are covered from day one. And for certain conditions, especially things you can plan for, like a cataract surgery, the waiting period can be much longer, anywhere from 1 to 4 years. You just have to wait it out.
But let's end this part on some really fantastic news for all of us. By law, insurers in India must offer you lifelong renewability. What does that mean? It means they can't just decide to drop you or refuse to renew your policy because you're getting older or because you've made some claims. As long as you're honest and you pay your premiums, you're protected. That is a huge deal.
And there you have it. We started out feeling lost in a maze, but by breaking it all down, the 3 paths, the ways you can customize your plan, and the key terms in the fine print, you now have a clear map. You're equipped with the basic knowledge to navigate the world of health insurance with way more confidence.
So the final question is really for you. You have the map, you understand the basics, you know the main routes. What's your next step going to be in securing your health and your family's financial future? Thanks so much for joining this explainer.